Hey traders, Raghi here, and let's pick up the conversation about this morning. And we talked a little bit about fading the limit moves in the free video. We have the entire about the first hour of the archive of this morning's trades. You'll see step by step how I guided everybody through identifying the lows, waiting for the momentum, when the momentum typically hits. And so that is the playbook that you can repeat again and again and again for limit down moves that we would fade to the upside and limit up moves that we would fade to the downside. Now, I haven't gone into it with this kind of depth before in the chat room because it is very aggressive. It is very quick. But a lot of you said, hey, Rob, we want to see the way you trade these limit moves. How do we do it? And so I wanted to share the process with you. So if you want a really good 1 hour, just full on step-by-step workshop of watching how we do this in a live market, check out today's replay. And by the way, where do you find that? So when you're in the members area and you're in your futures dashboard, you'll notice there's a menu to the left, and at the very bottom you'll see Trading Room Archive, and it's within the Trading Room Archive that you'll see that you have each day, and you open that up and you'll have the session that I did with you this morning, followed by David's session, followed by Neil's session, etc. So all of that is here. So check that out, and they're available all the days. Every time that Neil or David or I are on a mic, someone's recording it, unless there's a tech issue, so you can go back and watch some of the archives going way back. All right, so that is there in your members dashboard. So the other thing I want to tackle here is the fact that I saw a little bit of chatter here and there, and I do get some questions from you all asking about the strength and weakness. So let's go over what we did yesterday and talk about what was the relative performance today. What was the strongest currency? Well, clearly number one is the US dollar, but number two was the Japanese yen. Now, what gets confusing sometimes, and certainly under normal circumstances, we can talk about a particular currency being down 0.5%, and that usually is a pretty weak currency. But it's a relative performance conversation, not only relative to the US dollar, but relative to each other, right? So once the US dollar is pinned to the very far left or the far right of this scale, you may have kind of an odd looking percentage where everything looked weak today, but everything wasn't equally weak today. So you still want to stick with the far right and the far left of this scale. The far left of this scale, the strong side of the scale, was still US dollar and Japanese yen. The far right, the weakness side of the scale, was the British pound and the Australian dollar. There is your contrast, right? That's your contrast. So if folks say, well, the yen is weak, it really isn't. Yes, it's down against the dollar, but in terms of this lineup, this relative performance lineup, it's the second strongest currency. So keep in mind, if the US dollar is pinned to the right, or if the US dollar is pinned to the left, everything else might look weak in relative to the US dollar, but in reality, you still want to kind of line them up and look at number one and number two, like this, to the strength side, and number one and number two like this. So if you're ever confused about the percentages, just line them up with one and two, and that will clarify your contrast. All right, so all day long we did have yen strength, which I know makes the fade of the limit down move sort of the antithesis of what I talk about most of the time. But remember, limit moves, and I know it's hard to believe, especially for those of you that have just started trading futures, it's really hard to believe that limit moves were once upon a time, and hopefully once again will be, a bit of a rarity. Limit moves are not common. Again, hard to believe based on what we've seen the last couple of weeks, but they are not common. So on the advent of one, it supplants, it just completely buries every other strategy that we would typically look at, because the psychology of the limit move is so widespread and so intense that yen strength, at least for a little while, is going to be put on the back burner while fading the limit down move and waiting for those V-score readings to give us where the market might find traction to the upside is the main goal, the main setup. We focused on the ES because I felt it had the best structure. And we focused on the ES because you really don't want to be in multiple fades because things can get very sketchy very quickly. So we focused on what looked like the best, most reliable retest of the V-score. So realize that we really didn't do anything to the long side until we had a retest of the V-score, and that didn't get us long until almost 15 minutes after the bell rang. So we're not fading it right on the open. I know a lot of folks do, but that's not actually what you want to do. The two most common things you're going to see are traders looking at the first 1 minute and about the first 3 minutes, maybe 5, but really the first 1 minute and the first 3 minutes, so the first 60 to 180 seconds. And they're going to be looking for the highs that are put in the first 60 seconds, and the first high that's going to be put in, or the highest high that's going to be put in the first 180 seconds. And what they do is, as the market moves higher through those levels, the momentum and scalpers are out in force. But what you'll realize sometimes is as soon as the momentum and scalpers are done, the market, boom, retreats. And it's that retreat that gives us these V-score readings that we will, at what we believe to be the bottom of the range, will fade. Okay? So I'm not a big fan of buying at higher highs. That's not the way that I like to do things. It's valid, and I know that psychology is going to reveal ultimately what we do want to do, and that is wait for the pullback, wait for the market to retest levels, in this case a V-score level. If the VWAP was in play in a clearer way, which clearly it was not, as the price action sliced and diced through it. So if you're getting the sort of, let's call it the Ginsu knife pattern, where the market absolutely ignores the volume weighted average price, we will then rely on the V-score, not the VWAP. So we got long, and I was bringing up a few levels today, and they're in the notes that I sent out to everybody, so members get my session notes. And we knew that the 2447 level was the halfback, and we knew 2350 was the swing low. And that swing low is what I call the release the Kraken level, because if we broke through that, we were looking for a whole lot more weakness. But what we were focused on is how could we buy puts at the top of the range, knowing that top of the range was probably going to be pretty close to the halfback, as the traders who just took advantage of the limit down move, fade, bought it. And where would the ceiling be? My expectation was as close to 2447 as possible. So as we start climbing up in that area, we sure as heck are not getting long, right? We're not getting long up in this area. We are looking for exhaustion. We want to buy or get long those puts and take what the yen is saying, what the yen said all day long, is the ride back down. And that's exactly what happened. So one thing led to another. The limit down, we faded to the upside. And then once we got to that upside, as close to 2447 as possible, we start to look for the puts. Now, again, you might say, Rob, we didn't quite get to the extremes of those ranges. That's true. Okay, so if all it did was prevent you from getting long at the top of the range, congratulations, because that's what most traders do. And if you understood the power of that level and started to see some size build up there, you probably went ahead and bought the puts. But remember, you sure don't want to get long, and that kept you from a lot of pain. So if you took the first half of the morning ride higher with me, terrific. That was a great trade. And then if you were able to take the alert that I sent out, looking for those top of the range, right? Those toppy highs, buy the puts, boom. That was what we looked for. And then the other level that I mentioned, the 2350 level, the release to Kraken level, that's your swing low. And once the market lost footing there, you can see what happened after that. And it was a whole lot easier to be bearish for the second time through 2350. Remember, the first time we turned bearish was as the market closed in on the halfback, which was at 2447, and even thinking about the 50 level. So 47 to the 50 area, which is a major psychological level, right? That was pretty much it for the day in terms of the kind of trading that I focused on. Now, we also have the natural gas trade here. And, partly what we wanted to do with natty gas was wait for lower lows. And boy, did we get them. Fantastic. I mean, really nice move to the downside. Brand new lows, by the way, in natty gas. So one of the other alerts that I sent out, on top of buying the puts at the top of the range, the other thing was the update on the natty gas target, which was a 64.20 level. Easily hit that. And we wanted to scale out as we basically just shot down lower from yesterday's low. So this trade just continues to be giving us multiple opportunities to engage it. But I wanted to be a little bit more vigilant about paying myself because we've had that many blue and green grab candles and the trend is not as clear as it's been since the end of last year. So is this still shortable? Yes, but it's looking more like a distribution, choppy sideways market that still carries with it a bearish bias. It's not the awesome downtrend that we've had through here, but I will still look for shorts, but it's not going to be as clear, or probably it's not going to give us as great follow through until we start to get the reorganization of the downtrend again, which I am not going to assume. So let's pay ourselves proactively. This has been a terrific trade. How terrific? At this point, we're closing in on about a 3.5 times. So we paid about $1.09, $1.08 for these puts that still have, by the way, 30 days left to expiration. But we paid about $1.08 or $1.09 for these, and they're trading for $3.62. And they traded even more than that earlier. So this has easily been, as they call it, a 3x trade. It's almost 3.5. So terrific trade for us. And when you have an option that you're able to buy for $1.09, you're able to buy many multiples of these, right? And that's what's powerful, because then you could scale out as the trade goes in your favor. If this was a $10 option, most traders would not have that alternative, which is why you notice I will very seldom encourage expensive options buying, because it prohibits you from scaling out in this way. It typically forces you to buy one unit, maybe 2 units, 1 or 2 contracts, and then that's a very inflexible way to manage a trade. Inexpensive options give us that ability to scale out. So this has been fantastic. All right, so next trade or next conversation is gold. I've been getting a lot of questions about gold. No worries, I'm happy to hear the questions, but I am still, as I mentioned this morning, look, gang, I've been a bull in gold for over a year, since Q3, Q4 of 2018. We were buying gold entirely through 2019, all of 2019. We kept buying gold, swing trade or trend following pullbacks into the wave, oversold pullbacks as close to the 200 EMA as possible. So yes, the trend was broken, actually here, and then rebroken here. We still bought, by the way, you guys remember we bought this. And we bought this too, and when we sunk back into the wave. So now what? Well, this market has clearly gone into distribution on us. But until I take out 1450, this is the April contract, by the way, this is simply overbought up in here. So you can consider this your overbought zone, and this is oversold down in here. Okay? So I'm just looking for the market to go back and forth. This is not a downtrend. Those of you that took the tops class will remember I don't have the requisite grab candles and dots. I need at least 8 to 10 candles, the last 5 with the green or yellow propulsion dots, to confirm that a multi-month uptrend has actually turned into chop and then turned into a downtrend. And I'm not there yet. So I'm still looking at potential buys. You don't have to be a buyer, and I realize the precarious place that gold sits is right now, the place that it sits is being a commodity that is being liquidated in order to meet margin calls on limit down days, and it's probably still going to be subjected to that. Okay, so be careful, but I am still bullish. Finally, bonds. I do want to be a bond buyer. I realize, again, we don't know how an everything bubble bursts. This is probably the first time this market has dealt widespread with an everything bubble, as opposed to a tech bubble or a real estate bubble, or even the crisis. We've dealt with a financial crisis, right? But we've never dealt with the kind of crisis that we have right now, which is so widespread. Okay. Now, what gets liquidated? Is this capitulation? A lot of people are asking me, Rog, is this the low? Is this capitulation? No, this is liquidation, gang. And so the other thing that I'm looking at is, as the market liquidates a lot of different asset classes, are bonds going to get a pass? And I don't know that they're going to get a huge pass. I just think that right now they're not. But I do want to buy bonds. And so this is the setup that I discussed in the trading room, but I did not send it out as an alert yet because I'm waiting for the criteria to be met. So here's the criteria again. If we meet the criteria or close in on it tomorrow, I'll send it out as an alert. But just so you have a heads up on it, we're looking at the TLT. So take a good look at that. That's exactly verbatim what I'm going to send out when and if I feel comfortable about a bond bounce. And quite frankly, I'm really looking for the criteria to be met. Let's wait for the V-score to get to 1.0 to 0. Let's let the market come down to the 55 EMA, and then we will look for a potential ride higher. Okay, so let's get a little bit more of sort of a low. Let's get down towards the low of the range, and then I'll feel a whole lot better about getting long. Okay, all right, gang, that's really it. And again, I really want to caution everybody. Something I sent out on my Twitter today, on my Twitter feed. And do I have my Twitter feed up? Yep, I sure do. Couple things, okay? I'm nibbling here. Our infamous last words of bottom pickers who apparently want their teeth knocked out. Don't assume we're at bottoms until we get the bottoming pattern, bottoming process, okay? Because, as I posted here, in downtrends, we talk about this a lot in the room. In downtrends, it's not about which low you can buy. It's about which high you can short, all right? And crude oil, and by the way, natty gas, are both in that situation. Who thought that sort of congestion was the low? Well, they just got hammered today. Please remember, we need bottoming processes. And if I do feel there's a bottom, I will let you guys know. But your higher probability play is going to be shorting the rallies once we've gone double red. You can see the trade flags in the upper left-hand corner, double red. Bearish structure of your 8, 13, and 21 EMAs. Bearish structure of the 34 EMA wave. Short the rips. All right, gang, I'll leave you with that, and I'll see you in the next update.